Welcome to the Deep Dive, where we cut through the noise of the earnings calls. Today, we're digging into Eastman Kodak Company, ticker KODK, their Q2 2025 results. And wow, this one definitely made some waves, maybe not the kind management was hoping for.
That's putting it mildly. It's a real split story. Management's narrative on the call, all about execution, growth in their advanced materials segment, fixing the balance sheet.
Okay, sounds positive enough.
But then you look at the market reaction. Oof. Stock drops nearly 20% after the numbers hit. That tells you the street heard something very different.
What did they hear?
Liquidity risk. Serious doubts about whether the company can handle its upcoming debt. That's what drowned out everything else.
All right, let's unpack that. We have to start with the actual numbers because, well, they weren't pretty. They set the stage for that sell-off. Revenue first. Came in at $263 million, which is basically flat.
Yeah, down 1% year over year. So essentially flat, like you said. But that flat top line hit some real problems underneath.
Like the margins.
Exactly. Gross margin got squeezed hard. Dropped 300 basis points. Fell from 22% last year down to just 19% this quarter.
Ouch. 3 full points.
Yeah, and that flowed right down. Operational EBITDA took a 25% hit year over year, down only $9 million.
Okay, so weaker revenue feeding into much weaker profitability. And then the big one, the number that probably grabbed the headlines, the net loss.
Right, the GAAP net loss, a substantial $26 million loss, which is a huge turnaround from the positive net income they had in the same quarter last year.
So you put that all together, flat sales, shrinking margins, a big net loss.
And the immediate takeaway for investors was pretty clear, wasn't it? Operations look shaky, and despite the management talk about a plan, the market's laser focused on that near-term liquidity crunch, hence the sell-off.
Let's dig into why those profits were so weak. You mentioned the 300 basis point drop in gross margin. What caused that specifically?
It was kind of a double whammy. Lower volumes, for one, but also costs are biting. Higher commodity costs, they called out aluminum specifically, and just generally higher manufacturing costs overall.
Did they try to raise prices to offset that?
They did mention pricing actions, yeah. But they said it only partially offset those cost headwinds. So not enough to stop the margin bleed.
Okay, but you mentioned the GAAP loss was $26 million. Was there anything unusual in that number?
Yes, definitely need to point that out. There was a big non-cash item in there, $17 million asset impairment charge. It was related to an equity investment they hold.
Ah, okay, so if you pull that non-cash charge out.
The adjusted net loss looks more like $9 million. Still a loss, mind you, but significantly smaller than the headline GAAP number.
Right. $9 million adjusted loss versus $26 million GAAP loss. That's a big difference. But still, comparing even that $9 million loss to a profit last year, what drove that huge year-over-year swing? You said it wasn't just operations.
Correct. A huge piece of that year-over-year drop was actually pension accounting. Sounds boring, but it's critical here.
Pension accounting.
Yeah. They had a massive $25 million decline in pension income compared to last year. This excludes the service cost part. It's mostly about the expected return on the plan's assets changing.
So wait, a change in an assumption about pension returns accounted for $25 million of the worsening bottom line compared to last year.
Pretty much, yeah. So the year-over-year net income comparison looks much worse than the actual operational decline because of that big pension swing. It's accounting volatility, not purely business performance.
That's a really important point for you listening to grasp. The core business is struggling, but that headline loss number got seriously inflated by pension plan accounting.
Absolutely, which leads us nicely into looking at the different parts of the business. Where are things working and where aren't they?
Okay, so operations are squeezed. Where's the actual profit coming from, if anywhere? Let's break down the segments.
Right. This really shows the split inside Kodak. Their biggest segment by revenue is still print. That brought in $178 million.
Okay, the legacy business. How did it do profit-wise?
It actually lost money on an operational EBITDA basis, a $4 million loss this quarter. So the biggest segment is currently a drag on earnings.
Yikes. Okay, so where's the good news then?
The good news, relatively speaking, is in advanced materials and chemicals, AMC. That's their growth area.
What are the numbers there?
AMC revenue was $75 million. And importantly, it generated $8 million in operational EBITDA, so it's profitable.
So the story is the newer strategic parts are making money, but the big old printing business is losing money and dragging the total down.
That's basically it right now, yeah. The scale of the legacy issues is currently overwhelming the growth from AMC.
And adding to that pressure cooker situation, cash. How's the cash balance looking?
Not great. Unrestricted cash actually decreased by $46 million just since the end of last year. They finished the quarter with $155 million in unrestricted cash.
Okay, $155 million. That doesn't sound like a huge cushion, especially with losses.
Exactly. And that cash burn really highlights why these financing actions they talked about are so incredibly urgent.
Which brings us right to the elephant in the room, the balance sheet. And that really scary phrase, going concern.
Yeah, that disclosure in the 10Q, substantial doubt about its ability to continue as a going concern, that's about as serious as it gets in accounting language.
Why did they have to put that in now? What triggered it?
It's a strict U.S. GAAP accounting rule. It boils down the timing. Kodak has two major debts coming due in May 2026.
Which ones?
The Series B preferred stock and their main term loan. Because those payments are now looming within the next, well, roughly 12-month forecast period for the auditors, and the company hasn't already locked down the money to pay them off.
The accountants basically forced them to put that warning label on.
That's the gist of it, yes. Until the refinancing or repayment plan is completely certain and within Kodak's sole control, the rule says you have to disclose that doubt.
Okay, so what is management's plan to deal with those 2026 payments? This is where the KRIP thing comes in, right?
Exactly. KRIP. The Kodak Retirement Income Plan. This is the absolute centerpiece of their strategy right now. The plan is to terminate this U.S. pension plan.
Terminate it. And what happens then?
They expect there will be about $500 million in excess assets left in the plan after paying off all the obligations to retirees. They believe this money will revert back to the company.
$500 million. That's a lot.
It is. They estimate about $300 million of that will come back as actual cash, probably by December 2025. And that cash is specifically earmarked to pay off the term loan and handle the preferred stock.
Okay, so the plan is terminate the pension, get $300 million cash back by December next year, use that cash to pay off the debts due in May 2026.
That's the plan.
But relying on a pension termination windfall, which sounds complex and needs approvals, that feels, I don't know, a bit like a Hail Mary pass rather than a sustainable fix.
Well, that's precisely why the going concern language was required. Management is confident it will happen. They see the path.
But it's not totally done yet, and it relies on things outside their direct control, like regulatory steps.
Exactly. The timing, the exact amount, the process, it involves third parties. So from a strict accounting perspective, it's not a certainty yet. Management says, don't worry, the money's coming. The auditors, and clearly the market, are saying, prove it, show us the money.
Makes sense. Do they do anything else in the meantime to shore up the balance sheet or conserve cash?
They did. A few notable things. They managed to exchange their Series C preferred stock for common shares. That wiped out a $100 million obligation, plus about $24 million in accrued dividends that were piling up.
Okay, that helps the debt picture. What else?
They also set up $100 million at the market, or ATM equity facility. Basically, it gives them the option to sell new shares into the market if they need cash.
Have they used it? Sold any shares?
No. They specifically said no shares have been sold under that ATM program so far. It's just there as a potential backstop.
And one more thing, the interest payments.
Ah, right. For the Q2 interest payment on their debt, they elected to pay it all in kind, PIC, payment in kind.
So instead of paying cash interest, they just added the interest amount back onto the principal debt.
Correct. It saves cash today.
But doesn't that just make the debt bigger down the road? And isn't it usually a sign that cash is really tight?
It absolutely signals cash conservation is paramount right now. They're hoarding every dollar they can while they wait for that potential KRP windfall in December 2025. It's all about bridging the gap until then.
Okay. Let's pivot a bit. Management didn't only talk about debt, right? They tried to highlight the future, the growth story. What's the latest on that advanced materials and chemicals segment?
Right, AMC. That's the main growth engine they point to. The big news is their new pharmaceutical manufacturing facility. It's in Rochester, New York. It's now fully CGMP certified and registered with the FDA.
CGMP FDA registered. That sounds important. What does that let them do?
It's crucial. It means they can now legally manufacture and sell regulated pharmaceutical ingredients and products in the U.S. It opens up a whole new market for them.
Wow. So what are they starting with? Are they making complex drugs right away?
No, they're starting simpler. The first product they're making is phosphate-buffered saline, PBS. It's basically, well, it's highly purified salt water used in labs.
Salt water. That doesn't sound revolutionary.
The product itself isn't the point initially. The point is the certification. Getting FDA registered for pharma manufacturing is a high bar. By starting with PBS, they established themselves as a reliable, certified domestic supplier.
Ah, okay. So it's about building trust and a track record, paving the way for more complex stuff later, like IV saline maybe.
Exactly. It's a strategic first step into that regulated pharma supply chain. And it fits perfectly with their better theme.
Which is?
U.S. manufacturing. They really hammer at this point. They're committed to their Rochester facilities making film, plates, printers, ink there. They even highlighted they're the only U.S. maker of lithographic printing plates.
Building a made in the USA narrative. Did they mention tariffs at all?
They did. Interestingly, they said tariffs haven't really hurt them much so far this year. But they also pretty clearly stated they support tariffs that help U.S. manufacturers like them. So a bit of a political angle there, aligning with that domestic focus.
Okay, so U.S. manufacturing focus, pharma facility certified, and they also mentioned some traction with new printers.
Yeah, the Prosper 520 inkjet systems. They noted continued acceptance and some initial sales and installations in the commercial print side. So some positive signs in the core business too, but again,
It all comes back to the balance sheet and that ticking clock.
it really does. That's the overwhelming story right now.
So let's synthesize this for you, the listener. Management's painting a picture of a strategic fix underway, banking on that KRIP money. The market's seeing red flags, focusing on the immediate debt risk. How do we know who's right? What should people be watching?
Okay, I think there are three absolutely crucial catalysts. Three checkpoints that will either prove management right or confirm the market's fears.
All right, lay them out for us. What's number one?
Number one, KRIP execution. This is non-negotiable. We need to see confirmation of the steps. That means the annuity purchase for retirees, which they guided for October, then the lump sum payouts expected in November, and critically, the successful reversion of the assets, specifically that $300 million in cash expected in December 2025. Every step needs to happen on schedule.
Okay, KRIP timeline is paramount. What's number two?
Number two, pharma ramp-up. We need to see proof that the new Rochester facility isn't just certified, but actually shipping regulated products. Getting those first pharma sales confirms the AMC growth story is real and gaining traction.
Makes sense. Real sales, not just potential. And number three?
Number three, refinancing and liquidity. We need concrete news on how they're addressing the Series B preferred and the term loan that mature in 2026. A successful KRIP reversion in December should, theoretically, unlock progress here almost immediately. Or are they forced to tap into that $100 million ATM? Any news on refinancing or equity sales is key. Got it. QPOP execution, pharma sales, refinancing updates, those are the big ones to track. Okay. Now, we always like to end with something a little different, a thought experiment, a potentially crazy idea. So, standard disclaimer, this is purely theoretical, probably high risk, definitely just for entertainment. This is not financial advice.
Absolutely. Huge disclaimer. But
Yeah.
given the binary nature of this situation, you can construct some interesting, let's call them outrageous but plausible, trade ideas around that December 2025 KRIP catalyst.
Okay, I'm intrigued. What's the setup?
So look at KODK right now. It's trading like a distressed company, right? Huge volatility, high gamma, as the options folks say. Any little bit of news sends it flying or crashing, and it's all pinned on that May 2026 debt maturity risk.
But the key event that decides if they meet that maturity seems to be the KRIP payout in December 2025.
Precisely. It's almost a single point of failure or success.
Hmm.
If KRIP works as planned, the immediate bankruptcy fear evaporates, at least temporarily. The stock likely has a massive relief rally. If KRIP fails or gets delayed significantly, well, the picture gets much darker. So the trade idea is basically a bet on that specific December 2025 outcome.
Kind of. It's about structuring a bet to capture that potential explosive upside if KRIP works, while maybe funding it by betting against utter collapse before the 2026 deadline.
How would you even do that? Options.
Yeah, options are the way to play this kind of binary event. The idea would be something like a structured short put spread way out in the May 2026 expiration.
Selling puts. So you're betting the stock won't completely crater below a certain level by May 2026.
Exactly. You sell maybe some high delta puts, collect that premium. You're betting that if KRIP puts in December 25, the stock won't be near zero by May 26. Then you take that premium you collected.
And use it to buy.
You use it to buy cheap, far out of the money calls that expire shortly after that December 2025 KRIP, maybe January 2026 calls.
Ah, I see. So you use the money from betting against total disaster long term to fund a lottery ticket on a massive pop right after the KRIP catalyst hits.
That's the outrageous idea. If KRIP delivers the $300 million cash, those cheap calls could potentially explode in value as the stock re-rates higher, away from immediate bankruptcy fear and maybe towards valuing the AMC growth.
Yeah.
The short puts finance the call purchase.
It's definitely leveraged and relies entirely on that KRIP timeline working out just right.
Totally. High risk, high leverage, outrageous, like we said. But the timing of the catalyst is so specific, it makes structuring something like this at least plausible, if extremely speculative.
A fascinating, definitely nerve-wracking idea built around the calendar. Okay, let's bring it back. To recap our deep dive on Kodak's Q2, the whole story right now revolves around liquidity fears triggered by that going concern language in the filings.
Yeah, and management's answer is the KRIP pension termination plan, aiming for $300 million cash by December 2025 to tackle the 2026 debt. Until then, the core business is fighting margin pressures, even though there are bright spots like AMC's Pharma potential and the new Prosper printers.
The key takeaway for you: watch the gap between what management says and what the market does. That skepticism is real.
And keep your eyes glued to that KRIP timeline. October, November, December 2025. Those are the months that will tell us if management's plan holds water. It's the ultimate validation test.
Absolutely. Well, that's our deep dive for today. We hope this gave you some clarity on KODK and what to watch. Thanks for tuning in.
We'll catch you on the next one.